I just don't think that subscribers realize how rare it is to have somebody who's a Rhodes Scholar, who has the background at Stanford, the background at Yale, the background at Tiger Management, who personally managed Julian Robertson's wealth. I really don't think most people realize the advantage of having someone like that working on your behalf in his area of specialty, which is biotech. And certainly you don't have people who really, truly, actually understand that what can happen to your life when you have a $10,000 or $20,000 investment that goes 100 to 1.
I've been concerned about the dollar collapse since 2010. It's one of the reasons why I moved to Colombia. I'm worried about America, and as you can see, it's accelerating. I never really thought about this style of investment to protect against that downside of the dollar. But now that it's been brought up, I'm never going to unsee it. And this is something I'm going to give serious consideration to.
Welcome to the Porter & Company Black Label Podcast, your home for provocative insights that lead to lasting wealth. And here are your hosts, Porter Stansberry and Aaron Brabham.
Porter, special guest today. Crazy story of how you guys met. And also, I want to give the audience something. Stick with this, please. This is a longer interview. It's really important. It's something that could change your financial lives, but also you guys have do a fantastic long breakdown of what's currently happening in the political climate and what's the future of America.
Yeah, this is an important show. We're gonna end this show. If you will listen, you're gonna hear a stock that I believe is gonna go up 100-fold. So that's probably worth your time. You're also going to learn about why this is one of the most dangerous times we've ever seen in the financial markets or in the world since we've been investing, and that's for me over 30 years. So it's an important show. I hope that you'll stick with it. And the person that we get to introduce you to today is one of my oldest and best friends. His name is Erez Kalir. He, for many years, was one of the most talented and sought after, famed, if you will, of the quote-unquote Tiger Cubs. And these were the young hedge fund managers that Julian Robertson recruited to manage assets for him at Tiger Management. And Erez worked for years on Park Avenue, managed money directly for Julian, and the story of how we came to be friends and meet each other is pretty extraordinary. So I don't want to give away any more details. I just want to tell you, I think that in time, this will be the most important podcast that we've ever recorded. So I really do hope that you'll stick with us and listen through the entire message.
All right, let's jump in. Let's bring Erez on. Porter, we got the one and only Erez Kalir.
Erez, it's great to see you. Thanks so much for joining us. I can't wait to introduce you to some of our audience who may not know about you and the incredible work you've been doing for our subscribers in biotech. I want to start, if we can go back to the very beginning. Erez, I know you've told this tale a lot of times, but there's some people who probably haven't heard it. Could you please tell us a little bit about how you and I came to have a friendship? How did we meet?
So first of all, Porter, Aaron, thanks for having me. I'm delighted to be here. Anytime I get to talk with you, Porter, I know I'm going to have a fun conversation. I'm probably going to learn something along the way too, 9 times out of 10. So sure. In 2008, I found myself working in a story building in New York called 101 Park Avenue, which is the headquarters of Tiger Management and Julian Robertson.
Hang on. I'm going to keep interrupting you because I like the way you tell stories. Erez is very, very humble. So he says, I found myself in Julian Robertson's office in Park Avenue, or on Park Avenue in New York City. I found myself there. Okay. Please continue.
Yeah, no. I did find myself there. I'm not really sure how I ended up there. In any event,
that's like how I found myself in bed last night with my wife.
I just happened to.
I can't explain how it happened.
I was beamed there.
Sorry, Erez. I'll try not to interrupt you too much.
And it was the early months of 2008. It was after Bear Stearns had failed, but it was well before Fannie and Freddie failed, and even further well before Lehman Brothers would ultimately fail. And I had been working for a period of like 8 weeks on a deep dive on Fannie and Freddie. And the deeper that I dove in the research, the more just the arithmetic did not make sense. This was still now, of course, everything kind of seems perfectly clear, but it did not seem perfectly clear at the time because at the time, you had the Secretary of the Treasury, Hank Paulson, who was an extremely credible guy. He had run Goldman Sachs. He was not, on the face of it, some kind of clown. He was giving kind of sworn testimony in front of Congress that the GSEs was perfectly solvent and then there was no problem. And you basically had all of the Wall Street analysts that covered the GSEs for the sell side publishing research reports being like, this is an extraordinarily value buying opportunity. We've never seen these franchises so cheap. And let's remember that this was not too far removed from a time when, the ultimate sort of good housekeeping seal of approval buyer of anything in the world, Warren Buffett, had owned the GSEs as well. Now they're kind of like a laughing stock or a punchline, but that was not the case in 2008. So I was scratching my head. I eventually kind of came to the conclusion that they were a short and that they were very likely to go bust. But I did not, my own thinking was so out of keeping with what I was hearing in the rest of the world. And I was not yet at a stage, I guess, in my career where I totally had the courage of my convictions. That would be something that I would acquire at a little bit of a later stage. Anyway, I was working late one night and I had some massive print job. I was printing off, some 1,000-page document that I was going to read. And I had taken it to a Kinko's copy store to get the print job done. And as I was, and it was one of those big copy machines
the print jobs is the noble work that they do at places on Wall Street.
Well, we just
sure I'm a whiz with Excel, but you should see me with a print machine.
I didn't want to wait for one of those slow printers. I wanted one of those high-speed machines that doubles both as a Xerox copier and as a printer and can basically print 1,000 pages in 5 minutes instead of an hour and a half. So yeah. I was there, and long story short, I kind of opened the copier and I saw 2 or 3 pages of a research report, and I picked it up, and the headline said something like, Fannie Mae and Freddie Mac are going bust. And I'd never seen it before. It was obviously not. It was not from Goldman Sachs. It was not from Bank of America. It was not. It was
no.
not. And it said, the title said, Porter Stansberry's Investment Advisory, and there were only 2 or 3 pages of it. So I picked it up. I read it. I was immediately hooked. I was like, wow, this is really, really smart. I remember walking back to my office, I Googled it. I was like, I had no idea what Porter Stansberry's Investment Advisory was. I found the website.
You probably thought I was like an old man.
Yeah.
Yeah. And I was like, all right, I have to read the rest of this. I only got 2 or 3 pages. So I sort of figured out that I could buy the basic introductory subscription for $199 and get the report. I was like, listen, if the rest of this report is half as good as the first 3 pages, this is going to be the best $199 that I spent in my life. So I bought it. I printed the whole report, and long story short, it was really your report, Porter, which I think stands up incredibly well. Periodically I go back and reread it, however many years later, just to really kind of, whatever. It's like reading a beloved book or rewatching a beloved movie, just to really see if it still stands up. And I still think it's one of the finest pieces of financial writing and financial detective work that I've ever read in my life. I think it stands up incredibly well, however many years later. And it was really
it's definitely my very best work.
I have other favorite, there are other pieces that I years ago that I love also.
I just thought besides the finance in that piece, which is of course turned out to be epic and correct. But the math was really simple. I knew that Fannie and Freddie combined owned or guaranteed 90% of the mortgages in the country. and I knew that at least 25% of the mortgages in the country were subprime. Ergo, they have to own a whole bunch of them. and if those subprime mortgages are worth 50% less than we think, then Fannie Mae and Freddie Mac are clearly worth zero. Yeah. And that's the whole math in the issue. It's not like I had any special access to information or anything like that. I knew the facts of the marketplace, and I could, look around and see that every single person had lost their home in the last 12 months. But what I like most about that issue is actually the lead. It's the story of the San Francisco earthquake and how the financial consequences of that didn't emerge for about 18 months because they had to actually ship all the gold to San Francisco to make good on all the insurance claims, and it took a really long time for all the gold to come out of the banking system. But as it did, liquidity became more and more expensive and dried up more and more and more until finally there was like this incredible hour on New York Stock Exchange where call money went up to like 100% premium an hour. Like you needed to borrow money. You had to pay huge interest rates because there was no gold left. And that drying up of liquidity was the exact same thing we were seeing in the banking industry in June of 2008 because everybody kept announcing these huge losses. So HSBC started it off with some kind of crazy write-off, $50 billion write-off in subprime. And then every quarter, Merrill Lynch kept coming out with a bigger and bigger number. So it was like $2 billion, $8 billion, $16 billion, $25 billion. And then everyone was trying to raise money because they were trying to staunch the holes in their balance sheets. And of course, the first guy who raised money, no problem. The second guy who raised money, Third guy who raised money, no fucking way. And so the whole thing was just imploding. So Erez, that's how we met, and you did something that nobody else did. A lot of people read that piece. Famously, the editor of Barron's magazine put it on the cover of one of their issues around that time. But you actually called me, which I think is really fascinating. I still to this day don't know how you got my phone number. That's one of those Wall Street guy tricks. They can find anybody. Mm-hmm. And then you called me and you invited me and Steve Sugar to come have lunch with you, which we did. And you and I have been talking about investing and business and life ever since, that's been a great friendship for me, almost 20 years now.
Yeah, truly, that was the long-term gift of finding that issue was meeting you, Porter, and as you say, getting to talk to you over now something close to coming on 20 years. It's actually, I just want to sort of say, like, it's in a way there is a history doesn't repeat but it rhymes. There is a full circle feeling to it for me now. I've been, I've said to some friends of mine, I've had a really bad pit in my stomach, and close to sort of sold off my entire stock portfolio only 3 times in my life. The first time, Porter, was back then when I met you, right around that time. It was on the eve of the global financial crisis in the spring of 2008. The second time was about 6 weeks before the COVID pandemic, really kind of blew up. And the third time was in December, after Trump was elected, and I watched Trump's acceptance speech on the eve of his election, where he sort of ruminated out loud. A bunch of people are wondering, what my administration is going to be like. And for those people who are wondering, I have a simple answer for you: promises made, promises kept. And I kind of thought to myself, all right, well, what has he promised to do? And the first thing that he's promised to do is crush the world with tariffs. So in any event, that's the third time. And anyone who's read my newsletter, Biotech Frontiers, knows this because I wrote about it. I wrote about it in the December issue of Biotech Frontiers. So I kind of announced that loudly to Biotech Frontiers readers, and I've been repeating it basically every month that I've published the newsletter. Doesn't mean that I'm out of stocks entirely, but it means that I've become drastically kind of more selective about what I own in the stock market. But what I wanted to say to you, Porter, is that one of the things that reminds me of that period in 2008 is it's curious. There's a curious paradox to me because Donald Trump has some of the most financially sophisticated, accomplished people in the world working in his administration. Scott Bessent, the Secretary of the Treasury, is one of the most legitimately sort of celebrated hedge fund managers of his generation. And he was taught by, anyone's kind of first ballot Hall of Fame of two of the greatest
The
investors of all
GOAT.
time, like Stan Druckenmiller and George Soros. People can hate on
Yeah.
George Soros for his politics, fine. And, like we can, whatever, like it doesn't matter. He's like, his track record speaks for himself. Like these are two incredible investors. And
Druckenmiller has done 49% a year for 40 years or something insane like that. He's incredible. Yeah.
so the notion that sort of Scott Bessent is the Secretary of the Treasury while all of this is unfolding today is a real head scratcher.
I agree. It's a paradox.
To me. So anyway, the whole thing gives me 2008 vibes.
I wanna go back and tell you, it's interesting that you said there have been a couple times in our careers where you and I are good analysts. I shouldn't say that about myself, but I have a track record that can prove it. You're a great analyst. I'm a good analyst, and there's very few times when we've seen in the markets, and I've been following the markets on a daily basis since 1992. It's not forever, but it's a long time, and I've seen a lot of cycles. And I've also covered a lot of markets. I covered Latin America, all the 7 markets there for a decade. I covered China and basically Asia ex-Japan for a decade. So I've seen a lot of markets. I've seen a lot of manias. I've seen a lot of corrections. I've seen a lot of nonsense from governments. But the only time I ever wrote a get out of the pool, which is my expression for that, get out of the pool, report or essay was, I didn't write the first one, but I helped it write it. It was with Steve Sugarroot in January of 2000. Steve wrote a very famous lead to the Oxford Club newsletter, the communique in January, saying that we were at the top of a historic bubble, and that stocks were going to crash, and that that tech stocks would fall 80%. And I don't, my name isn't on that essay, but I definitely helped Steve with all that homework, and I understood that we were on the precipice. So we put trailing stops on all of our tech stocks, and we were out of the market completely by the end of October 2000. And we didn't get back into the market until, and I was short a whole bunch of stuff too, we didn't get back long again until October of 2002, which is very close to the bottom. And then I wrote, if you can go read it if you're a Stansberry Research member, in January of 2008, I wrote there is no question that we are going to have a bear market this year, and lots of stuff is going to go down. And then in June of that year, it was the get out of the pool. There is no safe haven. I said in June of 2008, I said, there are 2 stocks I'm certain that will survive this catastrophe, and if you buy them during this crisis, you will make a killing. And the one was Moody's. Moody's was my single stock pick in the fall of 2008 when we were in Mexico. We had our annual alliance meeting on the beach in Mexico at what's it called? The Lowe's Hotel down there. Anyways, no, maybe it's the Fairmont. Doesn't matter. South of Cancun. And I said, look, Moody's is gonna take a beating because they did all the research on all these mortgage securities, but they're not going out of business. And it's one of the greatest businesses that's ever been created. So in the crisis, buy Moody's. And then the other stock I said to buy during the crisis was NVR. I said, if NVR trades below $400 a share, you buy it with both hands. I don't care how bad things look. That business is not going to go out of business. It's one of the greatest companies that's ever been built. And the next 20 years, NVR was the highest performing stock in the entire stock market. And Moody's has done about 30% a year since the crisis as well. So great ideas. So what I'm trying to say is, Erez, is a lot of people, they want to paint you or me as, oh, he's a bear, or oh, he's a he's a crazy tech bull. And the reality is, you and I are very rarely fully bullish or fully bearish. There are times where the risks clearly outweigh the opportunities. And I'd say about the middle of 2024, there was no possibility that stocks were going to continue to perform anything like they had. And I wrote a guest Friday Digest for Stansberry Research last August, and I laid it out. The stocks are at an all-time high. There is no way that things can get better. And so I don't know exactly how they're going to unravel, but they will, because when you can't, when things can't get any better, you know, when the CAPE ratio is at 38, it's not going to get any better.
Yep.
And when you've got a situation where the Fed has done raising, it looks like it's going to be, you know, the next move is going to be a cut. All that optimism is priced into the market. It's whatever the news is, it's going to be a sell the news situation. Now, I don't know if we're going to get a 20% bear market, or we're going to get a 10% correction, or maybe we're going to have 3 years of flat to down, or maybe we're going to have the Great Depression. But what I do know is it's time to raise cash. And so at our conference last fall, I said the only strategy I can endorse right now is the permanent portfolio, where you only have 25% of your equity in stocks. And I think that's the market we're in right now, or maybe even worse. And I know you're here because you have a fantastic biotech letter, and I want to get to a biotech question for everybody. But because you and I have studied the markets for 30 plus years, and because we're in such a unique situation today, what I'd like to, I'm going to put you on the spot, and I want an actual number. What do you think the percentage chance is that we end up in a real historic collapse in terms of the dollar, the global financial system, and, of course, therefore, the stock market? What are the chances that the Dow falls 80% from its high that we saw last year?
Look, I don't know about 80%, but
I know, but that's the question. I'm not asking if all these changes that are happening are definitely going to cause a recession. They're definitely going to cause a bear market. I don't think there's any way we escape less than a 30% drawdown. Maybe I'm being too pessimistic, but I'm asking you the calamity question. If you look at what gold has done over the last 6 months, it's clear people around the world are pricing in a calamity. Are they going to be right? Or this is also the first time I've ever seen a 6-month period where every month the individual investor survey was bearish. I sent you that data. I mean, people are clearly afraid. How many times, Erez, have you seen the VIX close over 50? It is the amount of fear in the market is extraordinary. And if we're not at a calamity, if we're not going into a calamity, then I believe this could ironically be a very good buying opportunity. Because if there isn't a calamity and Trump is able to get our trading partners to lower tariffs instead of destroying the world, he could actually make it a lot better. Listen, that's not my base case, but I've seen stranger things happen in the markets. So my question to you is, what are the odds in your mind as an experienced player, knowing the people you know, knowing the current political situation, what are the odds that we have a genuine calamity? And I'll give you a little detail. A calamity would look like some kind of a disorganized default in the U.S. Treasury market. A calamity would look like a majority of the world's central banks shifting significantly away from the dollar as their reserve asset. Doesn't mean they wouldn't hold any dollars, but they would move away from it dramatically. It would lead to the creation of some other multi-state, multi-asset-backed global exchange system. The new system could involve Bitcoin, could involve gold, could involve receipts, could involve the euro, could involve a new currency block from China. Basically, so that we wake up in 5 years and people can't believe there was ever a time we were able to print enough dollars to pay for anything we wanted, because now it doesn't work that way. That's a calamity. That's the end of America scenario. That's what I've been predicting since 2010. What are the chances that we're at the start of that water slide, that flume ride down in terms of loss of purchasing power of the U.S. dollar?
Look, I think that they're pretty high, Porter. But I would reframe it a bit, and I'm not trying to duck your question. I'm just trying to elaborate my own base case scenario and thinking about it. I don't know.
Judges, can we allow the reframing?
Let's see how the reframe
All right,
goes.
We allow it.
Here's the reframe. I don't know that it will, or that it has to unfold in a highly dramatic way, right? Like, to paraphrase, T.S. Eliot, right? Like, this is how the world ends, not with a bang, but with a whimper. there's another scenario where there's
Can
not.
I give you another good quote like that? Just sorry to interrupt, but it's Hemingway. It's how you go bankrupt. It happens with countries too.
Yep.
Slowly at first, and then all of a sudden.
Yes. Exactly. So look, back in 2008, we had these really, really dramatic events, right? Like we had the GSEs kind of declared insolvent and put into conservatorship. We had major banks that, storied Wall Street banks that had existed for over 100 years, and
Yep.
so that sort of failed all of a sudden, and overnight,
Yep.
you opened up the Wall Street Journal, and the next morning, in sort of big font, in sort of it.
And it's stuff. It's also, there are institutions that you thought would never in your entire lifetime fail.
Right.
The idea that AIG was going to fail was unthinkable. The idea that Fannie and Freddie was going to fail is unthinkable. These things are bedrocks of the entire financial system. AIG underwrites every bank reserve asset that's out there. And Fannie and Freddie, they're the people who create what are called agency debt, which is just as good as treasuries. Like, these things can't fail.
Yeah. So
it was really dogs and cats living together. If you're familiar with Ghostbusters, the streams had crossed.
totally. So that is like the dramatic version of how of how the financial world gets messed up. There's a less dramatic version which doesn't involve sort of opening up the Wall Street Journal one morning and reading a shocking headline, which is maybe more kindred to the way that Japan unraveled over sort of over like a 10-year period, where
that makes a lot of sense.
Where the result is still awful. You're still talking about.
Do you know how long it took? You know how long it took Tokyo to bottom?
I'm going to guess north of 10 years.
20 years. So the peak was in '89, and the Nikkei peaked at 70 times earnings. I don't know if you have any of these reports still. I used to have a copy of a Merrill Lynch report about Japanese equity. They had a new way of calculating PE, because if they calculated it the traditional way, it didn't make any sense. So they just decided to calculate it differently, which is hysterical.
Yeah, so I think that my own base case scenario is sadly from America, for American equities, for the dollar, for the U.S. Treasury market, and sadly for kind of American standards of living, is much more Japanese. I think that's the precedent, or that's the history that this period is going to rhyme with, where over a prolonged period of time, 5 years, 10 years, 20 years, we are going to see a reversal or a shift away from U.S. assets. And I wrote about this in the Porter and Company Daily that you were kind enough to let me kind of publish as a guest yesterday, Porter.
Kind enough. I was so grateful for a day off. Thank you.
Would love to do it again. But I think that, broadly speaking, since World War II, under both political parties, this is not a Democrat or Republican thing. There's been a broad consensus for in the aftermath of World War II, right? The United States, we rebuilt Germany, we rebuilt Japan, right? We basically went to our two biggest enemies in World War II, which we literally bombed to smithereens, right? We flattened those countries, and we turned around, and with what at the time seemed like extraordinary economic generosity, we literally kind of rebuilt them and put them back on their feet, and they became two of the most important economic powerhouses of the subsequent sort of ensuing decades, and they became our allies. They still are our allies. And we rebuilt sort of a global trading system built on the sort of economic, military, and legal Pax Americana. And I think that chapter was an enormously profitable one for America writ large as a country. Like, we did very, very well economically under that sort of aegis. And I think that basically Donald Trump has blown that up. And I think that when you blow that up, it's really, really hard to put back together. Like, I do not think that a president who comes after him, whoever it may be, is going to find it easy to, to put that back together.
No, I agree. And just so the folks at home kind of understand a little bit more about what Erez is saying is, for the last at least 50 years, we have engaged in a system whereby we sent our dollars abroad to get cheaper, in some cases, much higher quality manufactured items. So think about Toyota cars, just to use an actual item, right? So it's cheaper for us to buy a high quality car from Toyota than it is for GM or Ford to make it here. And so therefore we got a higher standard of living without having to save, invest, or innovate. We got a much higher standard of living through trade, and we were able to do so simply by printing money, by creating credit, and by exchanging our bonds for their cars. And that has gone on to the point where now we're $35 trillion in debt. And what most Americans simply don't understand is how much of our standard of living is riding on that debt bubble. And what happens when you take that debt bubble away, I don't think people are prepared for. And I see a lot of people who are, let's call them the blue-collar Trump fans, who are like, oh, this is great, screw the stock market. Well, yeah, screw the stock market. But if the stock market falls in half, which I believe it will, you're also going to see unemployment go 25%. And so the idea that we have a U.S. president who is actively campaigning to end the greatest economic advantage our country has ever had is really unprecedented.
Yeah.
So let's talk about the paradoxes involved in this. By the way, he never did give me a percentage.
No, but you know what? You did shake your head, and it was a good analogy of Japan. So you were kind of on board with it.
I'll tell you another thing. I think Erez is wrong about this. I think there will be a very climactic, explosive moment. And the moment that I see is something I've been talking about now for about 2 years, which is that our largest, most important financial institution today is Bank of America. Bank of America has something over $2 trillion in deposits. It has 40% of all the deposits in the United States. It is the banking system. Well, they invested almost $700 billion in bonds during the COVID summer, the summer of 2020, when long-term 30-year interest rates were at 1%.
Oh, man.
The value of those bonds has gone down almost in a straight line, and I think those bonds are now down something like 40%. Could be a little bit more now. I haven't seen the latest price. But the point is they're hiding enormous losses. They say those losses today, Bank of America has disclosed, there's something on the order of $100 billion. Okay, so if Trump destroys this recycling of U.S. debt that has gone on for 50 years, what that also means is he's destroying the ability of the Treasury to refinance. We've got $9 trillion worth of treasuries to refinance this year, plus another roughly $2.5 trillion of new debt. So Treasury's got to go out and sell $11 trillion worth of treasuries this year. I don't know how that's possible if Japan isn't buying, if China isn't buying. And by the way, not only are they not buying, the world has been selling our treasuries on a net basis now for 3 or 4 years, and they've been buying gold instead. And so I think you can look at the price of gold versus the share price of Bank of America, and you can see something bad coming down the pike. Because if there is a failed auction ever, or if the Fed has to come in and start buying again, which is what they will do, the inflation expectations are going to go crazy, and there will no one sees this. There will be a run on Bank of America, and there will be a day where the ATM machines do not work. And by the way, people say, "Oh, that could never happen." Bullshit! It happens all the time. Fractional reserve banking systems fail all the time. They're built to fail. And that's what happened in 1932. And, of course, what did the government do? The government seized all the gold in the country in 1933. So I see a clear set of circumstances, like I did with Fannie Mae and Freddie Mac, that to me, the numbers are crystal clear. What's different about America as opposed to Japan in 1989 is Japan had like a 25% domestic savings rate. They had enough domestic savings that they could afford for their government to be 200% plus of GDP in debt. We can't because we have no domestic savings. Total domestic savings in the United States is less than $5 trillion. Less than. There's no way we can refi 11 trillion plus in bonds in 1 year because we don't have the domestic savings to do it, which means we depend on the kindness of strangers. And yet, what are we doing? We're pissing in those strangers' Cheerios. That is not good treasury management. And I'm telling you, this will happen this year. The Fed is going to have to go in to buy bonds again. And when that QE, quote unquote, starts again, there is the long-term yield on treasuries is going to go well above 6%. I think it'll go above 7%, could easily go above 10%. Nobody sees that coming. Nobody's pricing Bank of America equity right now at 10% treasury yield. In fact, if you want to have some fun, go ask Grok. Hey, Grok, which is, X's AI. Tell me what the situation looks like for Bank of America if treasury yields go above 10%. How could the bank survive?
Yeah, I think I think the scenario you're talking about is plausible, Porter. I think the only riff I would have on it is the Fed can pin the long-term treasury yield wherever it wants, right? They did after, as you know, they did after World War II, right? Like all they need to really do is raise their hand and say, we the Federal Reserve have decided that the the yield on the 10-year treasury note is going to be 4%, and we will buy as much as we have to, to defend that yield. And so the place where, of course, I mean, I know I don't have to connect the dots. The place where that would play out would be the dollar, right? Like they can do that. They can defend any kind of treasury yield they want, even on long dated treasuries, although they don't often do it, right? They usually just set the Fed funds rate. They usually don't go out to the longer end of the curve and say, we're going to pin the long end of the curve here. They have it within their ability to do that. And if they do that, we would see the dollar sort of destroyed, right? We would see effectively kind of a run, destroyed as we know it. We would see we would see a run on the dollar.
That's a very, very good point. That's a very interesting point. The Fed does have the firepower to set the interest rate and therefore to set the bond price wherever they want. So they can bail out Bank of America and all the other bondholders by inflating the currency. And that would also explain the price of gold going bonkers. So, whether we have a traditional default or whether we have a technical default, I don't see how we avoid some kind of default because we have literally run our creditors out of the treasury market.
Yeah.
And I would suggest to you that a plummeting value of the dollar is not real good for America's standard of living.
No, of course not. I mean, it would be the end of it would really be a sort of the end of an era of a really important chapter in American history where we enjoyed the exorbitant privilege of, controlling the global reserve currency.
Yeah. Well, now let's talk about the paradox, because the other thing that I know from investing through these cycles is that actually the very best time to be an investor is when everybody else is running around with their hair on fire, because that's when stuff becomes extraordinarily cheap. And my story about biotech about this is Regeneron. Dave Lashmet and I started following Regeneron coming out of the 2000 bear market, and we bought the stock for the first time. We bought it originally for around $20, and in the bear market in 2001, 2002, it fell all the way to $2. And fortunately, thanks to Dave, we stuck with it. So today, Regeneron is still a $550 stock. It's down from a peak of $11.53. So a $2 stock to a $1,000 stock. And I don't think I have to explain to people that kind of investment performance can literally change your life, even with as small as a $10,000 investment. So
you only need one or two of those in your life to be done.
That's right. And so what I'm trying to do with my own assets is, number one, I think that there will be tremendous volatility in the bond market. I think before the Fed steps in, if they do, like Erez suggests that they probably do, and I wouldn't argue that that's not likely. But I think you'll see at some point in the next 6 or 9 months, I think you'll see a point in time where the credit markets have as much fear in them as the equity markets did last week. So the VIX got to something like 60 last week. I think you'll see the spread over treasuries go and corporate high yield debt. You'll see them in the financial crisis. It went all the way to what was it? It went up to 20% over treasuries. So I mean,
I agree with that. I
points.
agree with that, Porter. I think that's coming down the pike.
I think you'll see a situation where you have 1,500 basis points premium, so 15% premium over treasuries. And by the way, these periods only last for a couple of days. It'll only be this way for 7 days, 14 days, less than 30 days, because the Fed will intervene. They will put the market awash in liquidity. And if you're able to get a 4 to 7 year piece of paper in duration with a 15% premium over treasuries, and by then I'm going to assume treasuries are going to be around 6 or 7%. So you're looking at nominal yields in excess of 20% on investment grade corporate paper. That's going to just be the investment of a lifetime for a lot of people. So what I'm trying to do is I'm trying to get something like 75% of my assets into those kinds of securities with the help, of course, of Marty Fritzen. So money good bonds giving me 20% yield. I'm really trying to find that situation. But the other thing I'm trying to find is the next Regeneron. And that's why we've got Erez. And so there will come a point where, Erez calls me or I call Erez and I go, are you convinced that your entire portfolio is going to zero? And he's going to be like, yep, I'm 100% sure there is no future for any of these companies and their current corporate structure. Great, I'm buying. Because that's the only time you're going to get the opportunity to buy these kinds of very valuable tech platforms for next to nothing. And, I don't know. I can't pronounce this stock, but I've bought one of them, Erez.
Alnylam.
Yeah, who can pronounce these things? Alnylam. I bought it at maybe around $250. I'm going to wake up one day, I don't know when, I'm going to wake up one day and that stock will be trading for $50 or something like that. It'll have a moment where it just pukes. Of course, I hope not. It'd be nice if it didn't because I already own quite a bit of it, but I'm expecting something like that. And why I like that stock, and Erez, is I think you've written about it, haven't you? Or is that something you told me about?
Both. I both told you about it and written about it.
Yeah, so they have this antisense platform, which is kind of like a modern version of monoclonal antibodies. And I'm going to let Erez talk more about this. I'm not the expert. But basically, they have a whole new way of interacting with your body where they can shut off certain genetic pathways to shut down proteins completely. So if your body is making problematic proteins because of genetic malfunction, they can shut it down in a whole different pathway than current medicine. So it's the next chapter in targeted therapy. And I was around for monoclonal antibody boom. I followed Amgen stock from EPO, which they made with Amgen wasn't a monoclonal antibody stock, but the technology, the underlying technology, the genetic engineering, Amgen was a great example of that. So was Herceptin at Genentech, the lead stuff. I'll let Erez talk. But my point is that when you see these new and entire tech platforms emerging, there is a lot of wealth that can be made because these things can affect human health in a very powerful way. So, Erez, the paradox is you and I are both about as bearish as we've ever been. We're expecting a very significant reordering of the global financial markets, and I cannot wait to buy biotech because these are the moments where you can actually make extraordinary returns. So when those moments come, when I look up and the VIX is trading at 60 and there's a 1,500 basis point spread over treasuries for corporate high yield debt, and I look and I see that Alnylam is trading, at $100 or something, down $50 in a day. What am I buying? What are the 3 or 4 things you're most excited about over the next 20 years, such that you're willing to look past this current turmoil?
I'm glad, Porter, you've actually connected the dots beautifully. Regeneron is is a beautifully chosen example because, readers of mine who have read the most recent issue of Biotech Frontiers will understand this. In the last issue of Biotech Frontiers, we talked about the two most important scientific breakthroughs from the 1970s that really, in some ways, created the biotech industry. The biotech industry today, as we know it, was built on the back, principally, of two very, very important Nobel Prizes. There was a Nobel Prize awarded to Dr. Paul Berg at Stanford for the discovery of recombinant DNA, which really was the first sort of effort or the first proof point that genes could be engineered, with human design. And then there was another Nobel Prize awarded for, the discovery or creation of monoclonal antibodies. And in that issue, we talk about how something like 5 or 6 of the top 10 selling medicines in the world today, including Keytruda, which is Merck's cancer drug, $29 billion a year in revenue, were built effectively on the basis of monoclonal antibodies. They are monoclonal antibodies. And Regeneron is a company whose franchise is really very heavily built on its command of innovative antibodies. And that is very much a monoclonal antibody byproduct. So when you talk about Regeneron, you talk about a principal beneficiary of that first wave of innovation in life sciences. And what we lay out in Biotech Frontiers is, in the same way that the first big era in biotech was driven by two Nobel Prizes, the Nobel Prize for recombinant DNA, the Nobel Prize for monoclonal antibodies, in the past 15 years, there have been 3 interrelated Nobel Prizes. One of them, a Nobel Prize for RNA interference and siRNA. Porter, that is Alnylam. Alnylam is the leading public company that is capitalizing on or building on RNA interference and siRNA. The second is the kind of Nobel Prize associated with the CRISPR-Cas9 system and the application of CRISPR-Cas9 to precision genetic editing. And the final one is the Nobel Prize that was recently awarded, I believe it was last year or the year before, for the application of messenger RNA and mRNA technology to genetic editing and to medicine, which is really what enabled the COVID vaccines, but not just the COVID vaccines, is now enabling things like cancer vaccines and a whole new array of medical innovation. So this is a long-winded way of saying, I think you are exactly right. I think that there was a small number of 100-bagger and sort of 250-bagger companies that came out of biotech and that seized and ran with that first wave of innovation in life sciences. And I think that we are now at a tipping point moment scientifically in biotech, where you've had these 3 overlapping innovations that are going to create revolutionary new kind of applications and pathways in medicines, and will ultimately kind of create trillions of dollars of value. And that happens to coincide with a moment financially where you can buy these companies for next to nothing. The companies have, that is the paradox, right? The paradox is scientifically, they're more promising than scientifically and medically, and therefore commercially, they're more promising than they ever have been, but financially, they're as inexpensive and hated as they ever have been.
Yeah, I really hope people will understand this. I really do. If I could just reach even just, one person or 5 people, then Erez and I are going to be able to change their lives over the next 5 years. But I do want you to understand this. In October of 2000, right, which is not the top of the tech bubble, it was just still, pretty inflated. Regeneron was a $30 stock. Okay? Now, if you go and you look at it 5 years later, it's a $5 stock. Mm. So are you going to be able to handle that kind of a drawdown because that is what it takes to invest in these names. Now, from there, that was in October of 05. So 5 years later, can you imagine, Erez? $25 a share to $5 a share over 5 years, or almost $30 a share to $5 a share over 30 years. Okay, sorry, over 5 years. All right, but in the next 5 years, the stock goes to 542 by 2015. So over the next 10 years, it goes 100 to 1.
Yeah,
that's what it takes. And so when I bought Alunum, I still can't pronounce it. Alunum. I bought it at around I don't know where it is right now. It was maybe around 250, 230 a share. I am confident that I will get a chance to buy that stock also at 150 and also at 100. Now it may not, because those prices for Regeneron were before it had approved products, and Alunum has approved products and has cash flows. So it may not be as volatile as Regeneron was. But my point is, we are at the beginning of the valley of death. We are at the beginning of the valley of death. And if you are going to walk in these waters, you have to have Erez. The only way I was able to know that Regeneron would be a winner was because I had Dave Lashmet, who at that time was our biotech ace. Erez is our biotech ace. He has the background. He could sit here and talk all day about his personal friends who also went to Stanford, who have built these biotech companies. He knows these people personally. He didn't just call me. He talks to all these people. You know, when I say call me, I meant with the Fannie and Freddie stuff. Like, that's Erez. He reads something cool. He reaches out. He talks to the people. Erez, you're in Oakland right now. You and I had a laugh about why you and I both live in the highest tax, most dangerous cities in the country. But I'm in Baltimore. You're in Oakland. You think we make better choices. But in any case, you have access to Stanford. Can you give us a little flavor of the last time you were over there or over at a lab and some of the stuff you might have seen without breaking any confidences?
Yeah, I mean, look, the San Francisco Bay Area, the United States has two biotech hubs. One biotech hub is in the San Francisco Bay Area. Another biotech hub is in Boston. I don't think that it's an accident that the Boston Biotech Hub is built around MIT and Harvard, and the San Francisco Bay Area Biotech Hub, even though the Bay Area is sort of in some ways better known for Silicon Valley, and for, technology innovation in software and in chips and in that form of high tech, Stanford, UCSF, and UC Berkeley are three of the preeminent research, and actually Lawrence Livermore Labs, which is a national, sort of one of the U.S. national laboratories. You've got sort of a massive concentration of scientific talent here in the San Francisco Bay Area. And if you can, so again, go back in time, we talked about the Nobel Prize that was awarded for recombinant DNA. That was Dr. Paul Berg, who was one of the most storied professors of medicine at Stanford. A disproportionate number of, we talk about the Nobel Prize for CRISPR-Cas9. That was Jennifer Doudna, who is a professor of chemistry and chemical engineering at UC Berkeley. I hate to be kind of crass about it, but you can follow Nobel Prizes, right? You can see sort of where Nobel Prizes are being awarded in chemistry and in physiology and medicine, and a disproportionate number of those those Nobel Prizes are being awarded to scientists who work basically here at these universities, and so. I do have like a wonderful sort of opportunity effectively to go knocking on sort of laboratories' door. And if not, talk to sort of the principal investigators themselves, then talk to their MD, PhD students, and to just soak up in it, which I love to do. One of the funnest aspects that I have in sort of getting to write Biotech Frontiers is learning about how those breakthrough technologies and discoveries are being applied to create new medicines. And this is the right place to do it. Or I'd say one of the two best places to do it in America.
All right. Well, we've been on with you for a long time, and I think we probably got to let you get back to work. But I've got one final speculative question for you, which is over the next decade, what do you think will have a more profound effect on our economy? Life science or robotics?
It's a good question. I think they both will. Um, I think they both will, especially if by robotics, we mean automation and the sort of marriage of artificial intelligence technology to physical processes, and to automation. I think they're both going to be hugely, hugely important and consequential. And I think
Yeah, I think
they're both going to be sort of disruptive in very different ways.
Yeah, and I think it's just always important to remind people that you and I can be very cognizant of the current financial hiccup, the current speed bump we face. But I don't think that I'm more optimistic about what we can accomplish economically through technology and innovation today than I've ever been before. I mean, the AI revolution is real and it's profound. So I just want to temper some of the bearish talk that we've had today with the paradox, which is that the long-term future is really bright, and you can use sort of the idiocy of our politicians and our financial policies to pick up some really valuable assets, and especially if you believe that the dollar is going to be worth less over time, then these are really critical investments to make, because not only will you see your net worth improve, but you'll also it's a lot of asset protection to get out of the dollar.
Yeah, I mean, I would echo what you said, Porter. Fortunes are made during bear markets. I think that when I think about a bear market, I think about extraordinary opportunity, right? But it's a time. It's always necessary to be discerning in life. You have to kind of be discerning. And I think that it's especially important to be discerning during a bear market, right? Like, to me, all a bear market
Very much
means
so.
is, most of the time, it's probably okay to have a big chunk in some kind of Vanguard ETF, which just tracks the market. It's what Buffett tells people to do. Just buy a cheap Vanguard ETF and forget about it. That's the advice for most of the time. You can't do that in a bear market, right? Like, you can see your net worth cut by 50% or more if you just ride the Vanguard ETF in a bear market. So I would actually say that if you're ever going to roll up your sleeves and be more active in the way that you're managing your savings and your wealth, now is the time to do it. The precipice of a bear market is exactly the time to be doing that.
Agreed completely. Thanks so much for joining us, Erez. I appreciate it.
Thank you,
And I
Porter.
know that
It's
we
been a
will.
pleasure.
I know we're gonna talk again real soon. So we'll see you in a minute.
Awesome.
Porter, you know what I find most fascinating about the entire thing is the serendipity of a tiger cub managing money for Julian Roberts that goes to a random FedEx Kinko. It has on his mind this Fannie and Freddie idea, has not enough conviction.
He's working on it.
Yeah, he's working on it, but doesn't have the conviction. And then he finds 3 pages of a newsletter, your newsletter, that is convicted.
Yeah. Well, it's interesting how small the world is that if you're working at a high level on a certain thing, you come into the orbit of other people. And I have found that my whole career.
Yeah, that's amazing. Anyways,
Exactly
I
right.
think that's fantastic, and I'm so pumped to have him. We did our best with our subscribers to get them on board with Marty Fritzen's bond service, and we did pretty good. I was actually impressed. We got more than 5 subscribers. So out of 40,000 people, we got more than 5. I'm kidding. We actually did pretty well with that. You said when you and Erez got back together that this Biotech Frontiers might be the greatest financial newsletter that will ever have a track record in the history of newsletters.
And I'd say so far it is. I think so far his average annualized return is 40% plus.
That's right.
So you have one of the best analysts in the world and one of the best sectors for investors. And we're going into a period of time where the values in the sector are going to be outrageous. We call this Erez's paradox.
That's right. And it's erezparadox.com, EREZ paradox.com. And Porter, we wanted to only make this letter like a $10,000 letter originally because it deserves it, honestly. And we only wanted to make it part of the Partner Pass, which it is part of the Partner Pass. But we want people to really try this. So we are going to do a 1-year special You get it for 1 year at a great price, and we think it's really important for people.
Yeah,
to
and
do
I would,
this.
if I were you and I was shopping for this, I'd say, okay, I've never done any kind of biotech investing. Am I really going to spend a whole bunch of money to subscribe to a biotech letter for a year? And the answer is, yeah, you should educate yourself. Those opportunities are emerging right now.
Yep.
And you'll be ready for them. And they, as you can see, they're investments that can literally change your entire financial life. And you only need one or two. So try it, and then don't think of it as I'm buying this for a year. Think of it as, okay, this is my down payment to join the Partner Pass.
Yeah, that's right.
Because as you know, at Porter and Company, every penny that you spend with us is always money good.
You get a credit.
Yeah, towards when you get ready to join us as a partner.
That's right.
So you just think of it as a down payment, rent to own.
That's right.
And by the way, renting to own with the best analysts in biotech, not a bad idea.
No, not a bad idea. And like you said, one of the critical things too, Porter, is you got to have a stomach for this. The good news is you have Erez to have your stomach.
Yeah, you got to be aware that the volatility in these securities is outrageous. Outrageous. So you have to be prepared for that. And as long as you understand that, and you understand that your time frame is 5 to 7 years, not 5 to 7 days.
Yeah.
You can do incredibly well. And guess what? Is that hard? Yeah, that's hard.
Absolutely.
And that's why nobody else will do it.
That's right.
But it works.
Yeah, so what I would like to do before wrapping this up is challenge our listeners. If any of them, and I know a lot of them, are subscribers to Dave Lashman, I would like, and even for Erez, I would like for them to write into us at podcastfeedback@porterandcompanyresearch.com, podcastfeedback@porterandcompanyresearch.com, and I'd like for them to tell us, in their words, how they've had the stomach to do this, how their belief system changed, how they became better at being a biotech investor.
We have had, over the last 20 years, I have had dozens and dozens and dozens of people send me emails that say, I listened to you. I bought ID Biomedical. I'm up $5 million.
Yeah.
I bought Regeneron. I made $7 million.
These are real stories, real testimonials.
Real testimonials.
Yes.
People who reached out to us, who bought our newsletter, who put $50,000 into one of these stocks, and who, did the Rip Van Winkle strategy. Yep. I put it away. I didn't look at it. And I just kept following the scientific development because eventually the stock price will match the scientific development, but it doesn't happen right away. Anyways, it's a very unique investment discipline, and you have to have somebody who actually can read the science, who knows the scientists. And with Erez, you've got that. I don't know how many Rhodes scholars you have working for you right now.
Yeah.
But it's an incredible situation, right? He went to Stanford. He got a Yale law degree. He went to Oxford, and at Stanford and Oxford, he studied biochem. And he has been doing biotech venture capital for, I think, the last 7 years. So he knows all the players. He knows all the technology platforms. And he's going to make our readers a lot of money, as he already has.
Yes, he has. He absolutely has. So, all right, Porter, I'm really excited for this. Another thing that, it triggered with me, too, is now more than ever, the dollar is heading to your end of America. It's heading to the destruction of the world reserve currency. This does sound like an amazing hedge on top of, Bitcoin, on top of gold. Getting a few of these, I mean, if the dollar's going to go down, it would be great to have some of these, along with some Buffett, capital efficient businesses.
Yeah. It's just all about allocation.
Right.
So,
and with the bonds too, with Marty.
Of course. So there's a spot for this.
There's a spot.
Yeah. And so I as I do my portfolio, what I'm trying to end up with is at 70 years old, I'd like to end up with 8 or 10 equities that I've owned for 20 years or 15 years or 10 years that pay great dividends and increase their dividends consistently. Because when I'm 70, that'll be enough.
Sure.
Right? I'll put a cap in it and we'll just live on the dividends. Okay, but until then, I need to generate a lot of wealth.
Yes.
Okay, so yes, I have a huge position in Hershey. Yep, I sure do. And when Hershey gets down to 10, 14 times earnings, I'm going to keep buying more of it. Okay, we're almost there.
Yep.
It goes below 150, it's a steal. All right, great. Fine. I don't think I'll see Coke ever down there, but if I do, I'll buy some more Coke. All right, great. But that's where I want to end up.
Yeah, right.
In the meantime, I'm 52 now, so I want at least half my portfolio in Marty Fridson's ultra safe, money good bonds when they can produce equity-like returns. So when I get a total returns above 25% with Marty, I'm in.
That's coming.
That's my priority.
Yep.
My second priority is to stack those gains into permanent equity positions, okay? And then on top of that is the cherry.
Yeah.
And the cherry is, can I put anywhere between 5 and 20% of my portfolio into ultra-aggressive biotech? Or it could even be other kinds of tech.
Sure.
But, where I have a legitimate chance of going 100 for 1.
That's right.
And I'm telling you, those opportunities are very, very, very few and far between.
Yeah, well, the thing that I'm most excited about is, 2.5 years ago, you started Porter & Co., and you only wanted to get the best. It hasn't meant running out and getting 20. This isn't about selling 20 different newsletter services. This is what you just named is the holy trilogy.
That's it.
Of investing.
Well, there are areas where you have to have an informational advantage. Okay, you cannot buy a distressed corporate bond unless you understand the capital structure and unless you've read the entire debenture.
Which nobody does.
Nobody's going to do that, but Marty will.
Marty does. He
right?
loves it.
And then you can't invest in biotech unless you know the science.
Yep.
And that means reading a whole lot
Yes.
of research.
Yep.
And that's what Erez does.
Yep.
So these are areas where we can actually create a lot of value for our subscribers. And then, of course, the basic stuff, the easy stuff that I do, it's really easy. But for whatever reason, people
don't do it.
People won't do it.
They don't do
but
it
I mean,
well.
I can explain to you exactly how NVR is a forever
Yeah.
stock, exactly why Moody's is a forever stock, exactly why Hershey is a forever stock, and people will shake their heads and then they go buy an index fund.
Yeah, of course.
Okay. Well, I mean, it's fine.
Yeah.
But you can do a whole lot better.
Yeah.
And that's what we offer.
Yeah, I'm excited. It's like being on a mission, right? You've taken all your knowledge of all the things that you've learned positively and negatively and applied them at Porter & Co. And man, I just love reading all the stuff from our subscribers and what we're able to do.
So there's one more product I want to have
Okay.
that we haven't launched yet. There's one more product that I want to have, and that is there are a very small number of publicly traded companies that are led by world-class investors. And even though these things are a corporation, their structure is as a corporation, they are run like a private equity fund.
I've heard you talk about these.
They have very high credit ratings, they borrow capital, they allocate capital very successfully into private companies, and they buy companies on the private markets for 6 or 8 times earnings, and they get capitalized in the public shell at 12 or 14 times earnings.
Ooh.
So they really have a wealth-producing system that does work. And we just recommended one of them in my newsletter last week. It's called Lowe's. I'll give it away to the audience. You can read about it. And what I want to do is build out a whole separate research team that just focuses on following these. There's only about a dozen of them that are really high quality. Lowe's, interestingly, is structured a lot like Berkshire. It's built around a property and casualty insurance company, so you know I love it.
Yep.
But there's a bunch of these. And the idea I have is if you're the kind of investor that doesn't want to be hands-on, you don't want to have to figure out which biotech stock to buy. You don't want to have to figure out when it's time to buy Hershey. You don't want to do it yourself. Then you typically would give your money to an advisor.
That's right.
Okay, you can pay 1% a year, or an ETF, you can pay 0.5% a year. Okay, but you're going to get a watered-down result. My idea is, why on earth give your money to a no-name advisor when you can give your money to the Tisch family, which has run Lowe's for 50 years and has been compounding capital at 20% a year?
It's absurd.
And by the way, you don't have to pay them. They pay you.
Exactly.
It's a much better deal.
Yeah, that's great.
So I want to put together a whole, list of these great allocators. Danaher is one we've already recommended. Lowe's is one we've already recommended. Obviously, Berkshire Hathaway fits into this model too. And then what I want to do is they're hard. These companies are very hard to value because sometimes you can't just look at the PE ratio because they're doing things like, I'm making this up, but let's say one of them is building a toll bridge somewhere. Well, that toll bridge is not going to produce any earnings for the 5 years it's under construction, but that doesn't mean it's not time to buy the stock.
Right.
So you have to do a deep dive in valuation to understand what the assets are actually worth. And we can do that for the subscribers, and then we can tell you when it's time to buy. So you've got this pantheon of these incredibly great asset allocation businesses led by great investors, and we rank them for you, and then we tell you exactly when to buy them.
It sounds like some might be buyable pretty soon too. So now's a great time to look at these.
Yeah, these things are typically have a big finance component, and when finance gets hit, they get hit. So look at how many times over the past 20 years Berkshire has fallen in half. And so, yeah, there are great opportunities to buy these things.
Well, that's exciting. All right, Porter, well, that's our show today. We appreciate everybody, and we'll see them next month.
You guys, thanks for joining us. Thanks for giving us a great job. We love doing this for you, and we'll see you again next month.
Thank you for listening to the Porter & Company Black Label Podcast with your hosts, Porter Stansberry and Aaron Brabham. We'll see you soon.